Welcome to today's deep dive. I am so glad you decided to join us for this one because today our mission is to unpack a massive, like an absolute game-changing collision.
Yeah, it really is massive.
We are looking at what happens when cutting-edge blockchain technology slams directly into the oldest, most rigid, and historically immovable asset class in the entire world, real estate.
The immovable object meets the unstoppable force, right?
Exactly. And today's insights, they're extracted from a really fascinating set of notes and research excerpts we've been reviewing. It's titled The Blueprints of Tokenized Real Estate.
Right, and the blueprints lay it all out so clearly.
They really do. And I want to give you, the listener, the ultimate aha concept right out of the gate here, just straight from the top of our sources.
Go for it.
Picture owning a piece of a gleaming, ultra-luxury commercial skyscraper right in the middle of a major global metropolis.
Sounds pretty out of reach for most people.
Right. But the catch is, you bought that piece of the skyscraper for the price of a cup of coffee.
A cup of coffee.
Yes. No banks, no signing your life away on a 30-year mortgage, no giant stacks of notary paperwork, just pure code executing a fully compliant legal transaction in a matter of seconds. That is the reality we are breaking down today.
What's fascinating here is that we aren't talking about some theoretical niche crypto concept that might get a pilot program a decade from now.
Right, this isn't science fiction.
No, not at all. According to the blueprints we're analyzing, this is a $10 trillion shift. 10 trillion.
That number is just staggering.
It is. The source material makes it very clear that within the broader financial space, retail investors might still spend a lot of time obsessing over day-to-day token price action. But the tokenization of physical property is currently the single biggest real-world asset trend in existence.
The RWA trend.
Yeah, exactly, RWA. And the most crucial point is that it is reaching critical mass right now. We are watching the traditional foundations of how we buy, sell, and own the physical world fundamentally rewrite themselves.
Which means we need to talk about the friction.
The friction is the whole reason this is happening.
Right, because before we can truly understand why this new tech is so revolutionary, we have to look at why the legacy system is currently hitting a wall. And it comes down to a concept our source calls stuck capital.
Stuck capital. That is the defining historical problem with traditional real estate. I mean, it is the ultimate manifestation of stuck capital.
Because it's just literally cemented to the ground.
Literally. You take hundreds of thousands or millions of dollars and you lock it up in bricks, mortar, and land. And the market applies what we call an illiquidity discount.
Meaning, because it's hard to sell, it's worth a little less in terms of pure financial utility.
Right. Because it is notoriously hard to move, your capital is inefficient. You can't easily sell 10% of your commercial warehouse if you suddenly need to raise capital for a new venture.
You're either selling the whole warehouse or nothing.
Exactly. You are entirely tethered to slow-moving local markets, specific zoning laws, and highly localized buyer pools. If the housing or commercial market in your specific zip code cools down, your capital is trapped there until the macroeconomic weather changes.
Okay, let's unpack this because this is where tokenization enters the chat. The core mechanism is taking that physical building and creating a fractionalized digital representation of its ownership on a blockchain.
Turning bricks into digital tokens.
Yes, but for anyone listening who understands the crypto markets, a red flag probably just went up.
Oh, for sure, volatility.
Exactly. If you take an illiquid, slow-moving physical asset like a house, and you suddenly expose its equity to a global 24/7 digital exchange...
Doesn't that invite terrifying volatility?
Right. If I own tokens in an apartment building, I really do not want its value crashing 20% overnight just because the broader crypto market is having a bad Tuesday.
And that is the exact pushback legacy real estate developers always have. But the blueprints actually address this mechanic in detail. You have to separate the behavior of a standard utility token from an RWA token.
They act fundamentally differently.
They do. Real estate tokens are backed by the tangible yield of the underlying asset, the actual rent being paid by actual humans or businesses.
The cash flow anchors it.
Exactly. That cash flow anchors the token's intrinsic value. You have market makers and liquidity pools specifically designed for these RWA tokens that absorb irrational market shocks.
So it's not just swinging wildly on Twitter sentiment.
No. So while the token gives you the liquidity of a digital asset, its price action is tethered to the slow, steady reality of the physical property market.
That makes a lot of sense. The physical building doesn't move an inch. The concrete is still poured in the exact same spot. but the legal ownership of that building becomes instantly fluid.
The geography doesn't matter anymore.
Right? The traditional geographic barriers just evaporate. You are exposing the equity of that property to a global pool of capital that never sleeps. Think about the strategic freedom of that for a second.
It's massive.
You are lying in bed at 2 o'clock in the morning on a Sunday. You see a macro trend you like, maybe a new tech hub is being built in a specific neighborhood across the globe, and you instantly acquire a stake in a commercial property there.
Just tapping your phone.
Exactly. Or, on the flip side, you need immediate liquidity to cover a business expense, so you liquidate a fraction of your real estate holdings while you are waiting in line for a coffee.
It completely upends the legacy model.
Buying or selling property used to be this life-altering, stressful event that consumes months of your time and thousands of dollars in hidden fees.
And that ease of access is actively destroying another massive barrier.
Huh?
Historically, real estate, especially high-yield commercial real estate, has been a walled garden for the ultra-wealthy.
The country club asked.
Right. If you wanted to get into a Class A office building or a massive multifamily complex, you needed a massive amount of upfront capital, or at least the credit line to secure it.
You had to be an accredited investor with deep pockets.
The barrier to entry kept the average investor locked out of the best-yielding assets.
Which leads right into fractional ownership. Because of tokenization, you don't need $1 million in upfront capital. You don't even need $100,000.
You might just need $50.
Exactly. By breaking the legal wrapper of a single property down into thousands or even millions of digital tokens, the price of admission drops practically to the floor.
If we connect this to the bigger picture, the sheer efficiency gains here are what make that fractionalization possible. Let's look at the underlying math of the smart contract.
Because the math is what actually allows this to work.
A blockchain protocol can easily allow 10,000 different investors to own a fraction of one single property, and it tracks who owns what percentage down to the thousandth of a decimal point.
Try doing that with a traditional accounting firm.
You couldn't. No human accounting firm could profitably manage the cap table for a single property with 10,000 owners. The administrative overhead would eat the entire yield.
You'd be spending more on accountants than you make in rent.
Precisely. But for a smart contract, executing those calculations requires practically zero effort and costs fractions of a cent.
But let me play devil's advocate here. Because owning a fraction of a building isn't just about holding a digital certificate. Buildings exist in the real world. They break.
Roofs leak, pipes burst.
Yeah. What happens when a pipe bursts in a building owned by 10,000 anonymous token holders across 12 different time zones?
It sounds like a nightmare.
In the traditional world, getting 3 people to agree on a contractor is tough enough. Getting 10,000 strangers to agree sounds like a recipe for a decade-long lawsuit.
It does sound chaotic, but the blueprints highlight how elegant the on-chain solution actually is. The physical property is usually held in an SPV.
A special purpose vehicle.
Right, like an LLC, which holds the physical deed. The smart contract controls the SPV. When the property generates rent, the contract doesn't just blindly send every penny to the token holders.
Held some back.
Yes. It programmatically diverts a specific percentage into an automated maintenance treasury wallet. So when that pipe bursts, the property manager submits a quote to the network.
And the token holders have to vote.
Yes, they simply vote via a DAO, a decentralized autonomous organization, using their tokens as voting weight. The vote clears in seconds, the threshold is met, and the smart contract automatically unlocks the funds for the plumber.
It replaces the endless back and forth of a condo board meeting with instant programmatic execution.
It is eerily efficient. And that efficiency completely bypasses the bloated ecosystem that traditional real estate relies on.
The middleman are just gone.
Look at the typical closing process today. You have real estate brokers taking a massive percentage off the top. You have lawyers billing by the hour to review titles.
Escrow agents.
Escrow agents holding your funds in specialized accounts for 30 to 60 days. You have title insurance companies charging premiums just to verify that the seller actually owns the property they're selling.
It's just layer upon layer of friction.
But the blockchain ledger effectively renders all of those middlemen obsolete. The cryptographic ledger itself proves ownership instantly. replacing the title search.
And the smart contract acts as the escrow.
Exactly. It holds the buyer's funds and the seller's tokens and executes an atomic swap only when all conditions are met. This drastically slashes the overhead fees.
And it speeds everything up.
That's the biggest part. It shrinks the settlement time. You go from a 30-day escrow period down to a 3-second transaction finality.
That speed and reliability bring us to the actual infrastructure running all of this in the background. Because to execute that kind of atomic swap for a skyscraper, you can't just run it on a congested network where gas fees randomly spike or the chain occasionally halts.
Definitely not. You need serious enterprise-grade rails.
You absolutely do. To digitize a $10 trillion asset class, the underlying network has to be bulletproof. And the source material points specifically to utility chains to handle this load. They call out networks like Algorand and Hedera.
Right. The institutional players driving this trend aren't deploying on highly volatile networks or experimental layer 2s that might suffer from sequencing issues.
Or MEV manipulation.
Exactly, maximal extractable value manipulation. They require utility chains designed specifically to handle complex, high-value, enterprise-level transactions with absolute cryptographic finality.
And the research notes point out a really interesting dynamic regarding how these specific networks are perceived by the broader public.
The retail perception versus the institutional reality.
Yeah. Often, retail investors look at these utility chains and think they are too quiet. They aren't constantly dominating the social media algorithms with wild price swings, so they fly under the radar.
But ignoring them misses the massive underlying growth happening right at the protocol level. Providing the security and the consensus infrastructure for tokenized real estate is driving sustained, compounding adoption for ecosystems like Algorand and Hedera.
The actual utility is scaling.
Think about the transaction volume required to power a global tokenized real estate market. Every time a fraction of a property is bought or sold, every time a DAO votes on a maintenance repair, and every time a dividend is paid out, that requires network utility.
It all runs on the chain.
The real-world value being secured on these chains is growing exponentially, quietly laying the plumbing for the future of global finance.
Here's where it gets really interesting, though. We've talked about the mechanics of buying and selling, and we touched on the maintenance, but let's look at the ultimate reason capital flows into real estate in the first place.
The yield. Passive income.
Yes. And this is where the programmatic nature of the smart contract truly outshines legacy systems.
Because being a traditional landlord is anything but passive.
Exactly. The sources explain that these contracts ensure rental income is distributed automatically. Take a typical scenario for a legacy landlord. Managing property is rarely actually passive. You are tracking down late tenants, waiting for bank transfers to clear, keeping spreadsheets of who paid what, dealing with localized tax documents.
It is a part-time job just managing the cash flow.
But on-chain, the property manager collects the rent into a central digital treasury. From there, the smart contract takes over.
The code does the heavy lifting.
If you own exactly 1.45% of the tokens for a commercial plaza, the second that rent hits the treasury, exactly 1.45% of the profits are routed directly into your digital wallet, instantly, every single month.
And it goes even deeper than just routing funds. You mentioned localized tax documents. How does a smart contract handle a token holder in Tokyo, another in London, and a third in Texas?
Right, because the tax laws for all three are completely different.
The RWA token standards being developed right now actually bake regulatory compliance directly into the code. The token itself is programmed, so it literally cannot be transferred to a wallet that hasn't passed KYC and AML checks.
Know your customer and anti-money laundering.
Exactly. When the yield is paid out, the smart contract can dynamically calculate and withhold the appropriate jurisdictional taxes on the fly before depositing the net yield into your wallet.
That is incredible.
It transforms real estate from a labor-intensive physical management job into a truly passive income stream, identical to receiving a programmatic dividend from a blue-chip stock.
The scale of that is just mind-blowing. And what stands out in the blueprints is that this democratization of property access isn't just happening in major Western financial hubs. It is a truly global restructuring.
The beauty of blockchain architecture is that it is borderless by design. For decades, investors in developing nations have been systematically locked out of prime real estate markets in places like New York, London, or Tokyo.
The barriers were just too high.
The legacy capital controls, the punitive exchange rates, and the sheer logistical nightmare of a middle-class worker in South America trying to buy a rental property in Manhattan made it a complete non-starter.
But tokenization completely flattens that playing field.
It really does. As long as you have an internet connection, a verified digital identity, and a compatible wallet, you have the exact same access to a fractional piece of a commercial high-rise as a hedge fund manager does.
It levels the playing field. But obviously, those legacy hedge fund managers and massive institutions aren't just sitting on the sidelines watching this disruption happen.
Not at all. And this is a crucial detail highlighted in the source material. Big money is officially moving on-chain.
They aren't ignoring this.
No. We are talking about the major legacy banks and the massive global asset managers. The institutions that oversee trillions of dollars in traditional wealth. For the last few years, they were in the sandbox.
Just testing things out.
Right. Running isolated pilot programs to see if the cryptography actually held up under stress.
Yep.
But the sources confirm they are no longer just testing the waters. They are actively in the deployment phase.
They're building it now.
They are tokenizing their own massive portfolios and building the proprietary platforms needed to offer these digital RWAs directly to their institutional clients.
They clearly see the writing on the wall. The reduction in overhead and the massive injection of liquidity give early adopters too much of an advantage to ignore. But that begs the question of timing. Why are they aggressively jumping in right now, today, rather than 5 years ago?
This raises an important question, and the synthesis of the source material leads to a very clear conclusion about this exact timing. We have finally hit critical mass.
Critical mass of what, exactly? Technology or regulation?
Both. 5 years ago, the blockchain technology was too raw, and more importantly, the legal framework was too ambiguous. A major asset manager cannot put a $50 million commercial asset on a chain if the SEC hasn't clarified whether that token is an unregistered security or a digital commodity.
The compliance risk was too high.
But those regulatory frameworks are finally beginning to clarify. The SEC classifications of RWAs are becoming actionable. And as we discussed, the utility chains we mentioned have proven they can provide enterprise-grade security at scale without network congestion.
So the infrastructure is finally ready for the capital.
We are at the exact inflection point where the robustness of the technology perfectly matches the massive, pent-up institutional demand.
So what does this all mean? Let's take a step back and look at the whole picture we've extracted from these blueprints. We are actively moving away from an era of stuck capital.
Say goodbye to the illiquidity discount.
Right. We are leaving behind a world where wealth is trapped in illiquid 30-year mortgages and where every transaction requires an army of expensive lawyers, brokers, and escrow agents.
The old way is just too slow.
Instead, we are stepping into a system defined by 24/7 global liquidity. We are moving into an era of automated smart contract rent collection that dynamically handles cross-border compliance while you sleep.
True passive income.
And we are entering the age of fractional ownership, powered and secured by robust utility chains like Algorand and Hedera, democratizing access to the world's oldest asset class for practically everyone on the planet.
It is a profound structural rewrite of value. The physical world isn't changing. The skyscrapers are still made of steel and glass. But the invisible architecture of legal ownership that dictates who gets to participate in that value is being completely recoded.
The source material leaves us with a brilliant core question, and I want to pose it directly to you, the listener, as you think about the mechanics we've just discussed. Ask yourself, in this new economic landscape, would you rather own 100% of one single house tied to one specific local economy with all your risk in one basket?
Oh.
Or would you rather own exactly 1% of 100 different properties, spread across different cities, different countries, and different asset classes, trading as fluidly as the digital cash in your wallet?
It's a powerful shift in perspective. And to build on that, I'll leave you with one final provocative thought to mull over. If the tokenization of buildings means that fractional shares can be traded instantly, 24/7 on global exchanges, just like tech stocks,
Yeah.
how will that global, minute-by-minute market sentiment change the way we actually value the physical neighborhoods and communities we live in every day?
Oh, wow.
Think about it. If a negative local zoning report can instantly trigger a massive global algorithmic sell-off of your apartment complex on a Tuesday afternoon, the very definition of what makes a neighborhood valuable might shift in ways the legacy real estate market is completely unprepared for.
That is a fascinating dynamic to think about as you walk down your own street today and look at the buildings around you. Thank you so much for joining us on this deep dive into the blueprints of tokenized real estate. We hope you walk away with a sharper, more tactical understanding of how this technological shift is unfolding. Keep analyzing, keep exploring, and we will catch you on the next one.